Welcome back to SMSF Mates Daily Podcast. This is our general advice warning that we are required to warn you that any advice has been prepared without taking into account your objectives, financial situations or needs, and because of that, you should, before acting on the advice, consider the appropriateness of the advice having regard to your own objectives, financial services and needs, and where the advice relates to the acquisition or possible acquisition of a financial product, you should obtain a product disclosure statement, PDS, relating to the product and consider the PDS before making any decision about whether to acquire the product. Now let's get into it. Welcome everyone to podcast X. We say X because we're not quite sure what it is. I got someone waving a 5 at me, but we'll go with 5X. Of the SMSF mate.
That's how good it is. 5X.
yeah. We're 5 in. Hope you're still with us. I have a personal interest in CGT and tax, and so I have roped in my fellow SMSF mater, who happens to be a accountant. So this is a great way of getting free advice without paying my actual accountant to tell me. So
general advice.
Yeah,
general advice warning.
There'll be all sorts of caveats in my answer.
So this podcast today is about CGT and tax for self-managed super fund related investments.
All right.
Welcome, Ashwin.
Welcome. Thanks.
And Tim.
G'day.
So first question, I have self-employed, been self-employed for a long time. Always self-employed. I heard about this thing being tax related. It's a thing that I could potentially get a tax deduction for selling some of my shares in my self-employed business, and something about CGT discount into my super fund.
Right.
What have I misunderstood?
There's a few steps to go through there. I think what you're probably alluding to is there's some small business concessions for CGT, or capital gains tax, for those who don't know what CGT is. So typically in Australia, if you sell an asset, you pay capital gains tax on that asset. That there's a discount of 50% in your own name for selling those assets. So, for example, let's say you sell a share you buy for $5, you sell it for $1,000, you make $995. You get a 50%.
Good investment.
Yeah, not bad. That's a great return. 20x. You pay tax on half of that profit if you've had it for a year or more. If you had it for less than a year, you pay as normal income because you've earned it within that 1 year period. So there's a different tax rate in the super fund, but we'll get to that maybe a bit later. But there's a special group of rules for small businesses that still exist at the moment, depending on your small business meeting those exemptions. So how long your business has run, the turnover, the value of the business will guide your accountant to work out if you can use those exemptions. So what that basically means is, let's say you had that $995 capital gain tax, you might be able to reduce it another 50% discount if you've had it for a certain period of time. Or you might be able to reduce it down to zero if you put those funds into your super fund.
Right.
If you're under a certain age, if you're over a certain age, so, let's say you've reached close to retirement age and you've met that requirement, you don't even have to put the money into your super fund. You get the exemption. They're very generous CGT discounts, but you do have to strongly advise people to get advice from their accountant, and usually an accountant might work with a tax lawyer to actually get you that piece of advice, so you've got peace of mind.
So before I go agreeing to selling those shares,
probably find out your tax hit
Go
first.
And get your tax structure sorted.
Yes, and then the next question then is, what do you do with that money in your super fund? So, but make sure that's the right step for you, because you might want to actually use that cash to pay off your mortgage or go on a big holiday to France and drink a lot of wine.
Sounds good.
Sounds like Garrett's answer. So then you might not want to put it into super. So there's nothing wrong with not putting it into your super fund. You're not paying tax, but you're paying tax, but you're using that money in your current life instead of putting it into your super fund and not accessing it later. So there's quite a few decisions to make in that process, but good on you if you sell that return and get that sort of money.
Yeah, amazing.
So tax whilst working, tax in retirement, what are the differences?
Yeah, okay. So tax while you're working and you haven't reached retirement, so it's generally 15% tax.
And that's going in, right?
That's going in and earnings, right? So whatever
Right.
it earns, it pays 15%.
So I get paid $1,000 a week. I put $100 into my super fund.
You're losing $15.
$15
straight,
goes in
straight off
tax.
the bat tax, and then whatever that $100 or the $85 now makes. is
Yeah, so
taxable.
my 85 to just follow the maths through. My $85 goes into my super fund. I invest that. It goes back up to $100.
You pay tax on
I
that
pay
$15 on the
another
$15.
15% on the $15.
Yes,
Right.
right. So
Yeah.
while you're working, it's all 15% except for CGT. So CGT in your super fund, like you get that discount for having an asset for a year. In your super fund, that discount is 1/3. So you pay tax at 10%. So instead of 15, 2/3 of it's taxable. You pay tax at 10% on CGT. Now, if you're part of an industry or managed fund, they're doing those calculations for you, and it's already in your summary. If you're self-managed, an accountant or your platform is doing that calculation for you, so you know what your tax hit
So
is.
just to put it in an example, my $100,000 self-managed super fund increases by $10,000
on earnings,
on earnings in the year,
15%.
not dividends.
So dividends, the same thing. It's still
Okay,
taxed
so
at 15%.
all earnings.
All earnings, 15%.
Okay. What if I didn't sell my shares in the year?
There's no CGT tax.
No, so it's only when you sell.
It's only at realised point.
Right.
So, and that gets to another stage, I think, Tim's question there of retirement. So if your balance is under the cap, which is, I think it might be 1.7, but, check the
Million.
ATO, set 1.7 million per member, and you're in retirement phase, all those earnings are 0%. So the CGT gain could be delayed till you're retired, and then you don't pay any CGT on that capital gain. Now, if your balance of your fund is more than the cap, which might be, I think it's 1.7. Again, we'll have to check the ATO to verify that. But if your earnings are above that cap, you will pay tax at 15% for that proportion. So vast majority of your fund will still be tax-free, but it's a pretty generous cap.
So is that the balance of my super fund?
Yeah, so let's say you're a single member fund,
Yeah.
Gareth, and you got $2 million
Yes, for one person.
for one person.
Yes.
In your member statement, it says you got $2 million. Whatever up to the cap is tax-free, and the portion above the tax, you pay tax at 15%.
Right.
So there's some tax, because there was this only happened probably about 3 or 4 years ago. They introduced the cap because there were some people in Australia have got multi-millions in their
Yeah.
own name, and it's tax-free.
little bit
Didn't pass a
cheating.
pub test, I don't think, when people found out, you might have 2 million in your super and you're not paying any tax at all. Now 15% is still pretty low. I think most people can swallow that if they made that much, if they made money. It's only on the earnings, it's not on your balance. It's whatever you've earned in the fund. So just be mindful of that, and it's only the portion above that. So you're not like it's a rich tax or anything like that. Everyone's getting a cap that's tax free. Anything above that cap, you're paying
So
tax at.
if I've got $1 million and my wife's got $2 million,
Her portion is going to have some tax in there.
Right.
Now, there are some potential strategies maybe to recontribute if you can, to square that up so you're both under the cap, but you need to check how much you put in your fund, balances over lifetime to see if you can match that up. But those are things you'd probably sit down with your financial planner and line that up.
And it's only the amount above the cap
That's
that is taxed.
Yeah, and these are the rules as of today, right? So at any point, the government might turn around and go, hey, we don't like it being tax-free. It's going to be 15% for everyone forever and a day. And that might be the rule.
Right.
So at some point, I think super reforms will happen. But my personal view is I believe the government wants people to be self-funded retirees and not rely on an age pension. So there'll always be a benefit for having investments in super, but I don't imagine that when I retire, it will be tax-free. At that point, I think they will need that 15% tax to pay for all the stimulus we've received in the last 2 years, right? So,
All
but
the money printing.
who knows? It'll be a brave government to do that, and the ability of brave governments in this era is probably lower than in the Keating, Howard years where decisions could be made. So maybe it doesn't happen, but I think there might be a time when it might have to happen.
Right. And so as someone who has a self-managed super fund, do I have to sort out my tax, or does the accountant do all these calculations for me?
Usually your accountant, if you've engaged an accountant, will prepare that, and then an auditor will review those numbers and transactions within your fund to make sure you haven't crossed any lines. So yeah, you can. I think we've had a caller in the past that's gone through a platform that will do all of that for you.
Right.
So there are There's multiple options
so
around.
I don't have to do the calculations.
Knowing you, Gareth, I'm glad you're
The generalist question.
Yeah, good.
I'm sure there are listeners who would have asked the same question.
There are some clients that are very good at keeping the records and might be able to do it themselves. And as a trustee of your own self-managed super fund, you're perfectly fine to do it yourself.
Right.
So there's nothing stopping anyone from engaging an accounting platform, bringing in all their transactions, coding it correctly, then engaging an auditor to check their work. That will meet the requirements with the HO. So if you all power to you to do that.
Okay. Good luck to me, he says.
No. I'm sure you'll nail it, Gareth. No question.
What other tax questions can we think of, Tim?
Well, that's all I had actually on that topic.
Oh, really? Okay. Well, super fund related tax questions. So I think just because it was quite quickly. So, putting money into my super fund, isn't there a cap, like a $25,000 a year cap?
So it's 27,500 is the current cap. Right. So it's gone up because
that's a good. Did you know? Because I didn't know that.
Because the tax has gone up to 10%.
Right.
So they've I think it's 27.5 is now the concessional limit. There is a rule that applies, and it regardless of what sort of fund you're in, you can use your unused amount of the cap from the previous years in a year. So an easy way to explain that, let's say you're employed for, let's say $100,000 a year is what you earn. So your work's putting in, let's say $10,000 into super, and that's happened for the last 3 years. That means you've left on table $15,000 in the previous years, and then it could be another $17,500 that you didn't use in a tax deduction because you can sacrifice money in a super. The HO now lets you catch up and do a big contribution in year 4 or 5. Now that cap period is only for a 5-year window. It's really easy to get that information. You can usually get it off either your MyGov account. There might be a super statement in there, or you call your accountant. They can run the report in what we've got, our tax agent portal. We can run that report and say, hey, Gareth, this is how much you've got available. And if, for example, let's say you had a capital gain, like you said, when you sold the business and you didn't want to put it into super, or you wanted to put it into super, you can use that concessional contribution. So let's say you didn't meet any of the concessions, or you had a win on a share, that wasn't a business-related transaction, then you could reduce that tax by putting money in a super. Again, before you put money in super, you can't touch it. So
top tip.
So 27.5 concessional.
Yep.
That's the new limit.
That is the new limit.
What about so that includes employer contribution.
So total contribution to super per person, 27,000.
Regardless of how many funds you got or anything like that, everyone's got the same limit. So there's no special rule for self-employed people.
Right.
But if a self-employed person hasn't put any super for 2 years, well, they've got the last two 50,000s plus this year's 27.5.
Yeah, and that reduces your taxable income, right?
Reduces your taxable income, but that cash does need to go to your super fund. So you need to make sure you've got the money.
The money actually has to go in there.
It's not some paper transaction. The money has to physically go to either an industry managed fund or a self-managed super fund and fill out a notice of intent document has to be completed to claim the deduction.
Okay, and just non-concessional contributions. What's the go with that?
So non-concessional contributions are a bit different to the concessional ones. It's basically putting money into your super fund with no tax consequence. So let's say you might put in 50 grand as non-concessional contribution, whatever limits you've got, but we'll use 50,000 for example. You put 50,000 into your fund as a non-concessional contribution. You don't pay that 15% tax when it goes into the fund, but whatever it earns is going to pay tax at 15%. So earnings are still 15%, but you don't get a tax deduction, nor do you pay tax on it. So because you're not getting a tax deduction for it, the HO doesn't then slug you 15% to put it in there.
So for example, if I was to inherit $100,000, then I could put $100,000 into my super fund. I don't pay any tax on the $100,000 going into it.
As long as your limits haven't been breached, you're fine.
And then if that $100,000 goes up to $200,000,
you pay tax on the gain.
On the gain, which is $100,000 at 15%.
Yep. And, people will go, well, why would you do that? Well, I'm pretty sure the 15% tax rate will be lower than your tax rate outside of super. So if I was going to invest that $100,000 in my own name, then I'll pay top marginal tax rate. Depending on your income. So if you're someone, you might be 30%, or you might even be the 19%, or you might be tax-free threshold. So sometimes it doesn't make sense to put money in super. It depends on what your earnings outside of super are.
Yeah, and whether you need the money now or in 25 years or 10 years or however old you are.
Exactly.
Yeah. So it's quite an important thing to think through the process.
Yep, and inheritances are one of those things where I would engage an advisor at that point to take a big snapshot of where you are completely, and then you can make a call where you put that 100.
What about things like winning lotto or, betting or casino? I had someone I knew who won $50,000-$60,000 at the casino. I've never heard of anyone actually winning anything at the casino. But they actually paid out. Like no, I won't say they paid out. They actually on the spot gave him $75,000 in cash if he wanted it.
Yeah.
He went and blew a reasonable amount of it drinking, but. That's a different issue.
Could be more than 60. Earnings from gambling, as long as you're not a professional in that space, is tax free because you can't claim the losses, right? So if there's no tax deduction for that. That's your own choice of spending money, right? So otherwise, we'd all have potentially more losses to claim than. So good on you for winning it. It's probably the most common thing is people try and claim the tax deduction for the raffles. Raffles are not deductible.
Right.
Just a heads up, the amount of people that go into a few big lotteries to try and thinking they're helping a charity out, and you are helping a charity, but because there's a chance of winning, it's not a donation.
Yeah, interesting.
So it's not a deductible gift if you're entering it.
Yeah, because
Tim's smiling because he's tried putting that in his tax return.
People make the mistake. If you're participating in something that you could win something from, it's no longer a charity. It's not a donation. You haven't given it up.
Interesting.
Willingly.
It's funny how they don't put that little
it's there.
disclaimer up top.
It's definitely there in the receipt.
In the receipt,
but it's definitely there, not deductible.
But so the point is, I could win some money and invest it through my super fund.
Yeah.
Right.
But again, check where you can with anything you're doing. But general that's how.
Thank you for joining us once again. If you're interested in our waffle about self-managed super funds, feel free to join us on smsfmate.com.au or search SMSF Mate in Spotify.